Okay, thank you for joining us. My name is Josh Sussman with the marketing and program team at Nefesh B'Nefesh. We are very happy to have with us Jeremy Veda and Galit Friedman, who will be sharing their professional knowledge on tax considerations for American freelancers and businesses. I know there have been a handful of Canadians who are interested as well in this. It's less applicable to Canadians. And as Jeremy is an American lawyer, tax attorney, and Galit an Israeli one, I apologize that we might not be able to handle your specific issues for Canadians, but I am quite confident that we will be able to cover a great amount of ground here. The session is being recorded. We will be sending it out in the next 24 to 48 hours, the recording of the session, along with the PowerPoint presentation, contact information for Galit and Jeremy, and any other resources that we might share. Please put all your questions in the Q&A section. We prefer to use that. It's much easier to manage than the chat. We will not be using the raise your hand feature. So if you raise your hand, I'm going to lower your hand. But please put all your questions in the Q&A. We will be answering questions as we go through the session on the Q&A. If we have enough time at the end of the session, we will open it up and Jeremy and Galit will answer some questions at that point. But it is a very full session and we want to make sure we get all the information out there. So with that, I will let Jeremy and Galit introduce themselves and we'll continue on. Thank you, and we look forward to a wonderful presentation.
Thank you, Josh. Thank you for those kind words. Welcome, everyone, to Tax Considerations for American Freelancers and Businesses in Israel. My name is Jeremy Veda, and I'm a U.S. licensed attorney. I specialize in tax and business law, and as part of my practice, I assist international businesses who are operating in between the United States and Israel, as well as assisting individuals who are looking to make that plunge, looking to make aliyah, and are looking to sort of help mitigate the friction of the two tax regimes as they sort of make that move and continue to operate on a forward-going basis. I'm also joined by my friend and colleague, Galit Friedman. She's will give a brief introduction herself. I think you're still on mute, Galit.
Hello, everyone. Good evening. Thank you for joining us tonight. My part of the presentation will discuss the Israeli tax aspects of your relocation or your U.S. businesses operating from Israel. I'm an Israeli tax and private client attorney. I'm qualified attorney for 15 years, and I provide tax and business advice to individuals, corporations, on aspects of relocation and utilization of tax benefits, and application of tax treaties. We'll be discussing more in the next 30 minutes.
So really what you guys can expect here is you're gonna get both sides of this, of these considerations, both the US side and on the Israeli side, but with a particular focus to US persons who are looking to make aliyah. So, you know, as must be clear, as is definitely clear to all of you, U.S. business owners, independent contractors, and other self-employed persons face a whole host of considerations that are above and beyond what a typical wage earner would face. I mean, if a wage earner is sort of just moving to Israel, whether they're keeping their job in the United States or they are getting a job in Israel, their tax compliance is relatively simple, or more simple than a business owner. As you can imagine, with the sort of ordinary compliance that you face even now, just domestically, those complexities are compounded when you try and operate internationally, whether it's just you moving and keeping a client base in the United States, or trying to move your whole business, or trying to do both at the same time. Once you start moving internationally, in Israel in particular, it adds a whole host of complexity. So today the sort of main topics we're going to cover today on the U.S. portion is income taxes, self-employment taxes, and then saving for retirement, sort of retirement considerations. Just as a brief kind of step back for a second review of the U.S. international taxing regime, The US is a worldwide taxing and reporting jurisdiction. This means that regardless of where you are, where you're physically located, where you're living, Uncle Sam wants to know what you're up to. And so the default position is that all of your income is taxable. And then of course, there's a whole host of exceptions and ways to plan around it. But the default position is Uncle Sam wants to know how much you make and what you're doing with it. Even if you don't owe any income taxes, if you're not actually going to have to pay any tax on anything, at minimum, there's probably going to be some reporting requirements. The absolute bare minimum, once you move to Israel, you're going to open up a bank account. You're going to have to start checking boxes on your 1040, Schedule B, Part 3. There's a check the box right there for foreign accounts. Once you start hitting certain amounts, thresholds, more than $10,000, more than $100,000, depending on the situation, you have additional reporting requirements, additional forms you have to fill out, and potentially additional forms you have to append to your 1040. Importantly, services are sourced where they are performed as opposed to where the client is. So where the work is being physically done is going to be important for what we're going to be talking about here. So for instance, if you're living and working in Israel, both the US and Israel are going to lay claim to your income, but generally speaking, it's going to be sourced to Israel if you're physically located there. On the professional side, lawyers, accountants, consultants who might retain clients in the United States, your work is being physically performed in Israel if you are physically located there. So it is going to be sourced to Israel now. Same with remote work. If you are, now working for a company in the United States, but you're physically present in Israel, programming, what have you, there's obviously a huge migration to remote work these days. You are physically present in Israel and it is being sourced in Israel. And even what may seem sort of counterintuitive, but management services, even if you're being compensated as a CEO or like a remote COO or something, and you're in Israel, Israel is going to be able to lay claim to that work, to that income. So that's sort of where we are. Now, like I said, even though sort of both jurisdictions lay claim to it, there's an exclusion for foreign earned income in the United States, $108,700 as of this year is just sort of a right off the top. You can decide that you just want to exclude up to that amount of income. That means that for income tax purposes, as long as you don't hit that cap, you're not going to have an income tax obligation. You just have to meet one of these two tests, either the bona fide residence test or the physical presence test. If you're making Aliyah, all you have to do is be a resident of it, which you will be once you make Aliyah. Once you have been a resident for an entire year, you can then claim this exclusion. So usually what people do is that once they make Aliyah in Israel, they will extend their tax return for the subsequent year. And you can even ask to have it be extended a little bit further to kind of fall into this so that you can claim the exclusion even in the first year. So there's sort of some timing you have to do with when you're going to actually do the filing, but you can even absorb this. You can even use this in your first year that you're in Israel. You just have to wait a little bit longer to actually file the return. The other one is that if you're not actually going to make Aliyah, maybe you're going to come and you're going to kind of test it out a little bit. As long as you're physically present outside the United States for 330 days or more, you can also employ this foreign income exclusion. Now, there's pluses and minuses to it, and we're not going to get too far into that. But there's also, even if your income is above and beyond, the 108,000, you can use what are called foreign tax credits. Israel, by and large, has higher tax rates than the United States, which means that you should be able to shelter virtually all of your income, Israeli source income, and you won't have to pay tax on it in the United States because the rates are higher. There are some specific exceptions. There's an exception for interest income happens to be taxed more preferably in Israel as compared to the United States. But by and large, generally speaking, the tax rates in Israel will be higher, which will allow you to shelter your income for US income tax purposes. This usually results in the fact in you not having to pay US income taxes while you are an Israeli, while you're living and working and being in Israel. The major caveat to this is US source income. So, like I said before, if you're physically in Israel and performing services, they're going to be sourced to Israel. Well, the inverse is also true. If you're going back to the United States with some regularity and you're performing services there, or you're kind of checking in on your business or whatever it is that you're doing, and you're physically in the United States, then that is going to be directly sourced to the United States, and then you can get the reverse, and Galit will get into that, and you can get a credit for the taxes you pay in the United States for Israel. The US and Israel have an income tax treaty, so by and large, the income tax problems between the two countries, they're not completely solved, but they're a lot more harmonious than some other things. So, but just, you know, it's important to kind of know what they are and know that you're going to, especially if you're going to be traveling back and forth, you are likely going to be sourcing income to both, and you're going to have to be sort of careful about that on how you're allocating your income. You're definitely going to want a good accountant who knows how to prepare international US tax returns to assist you with this. The main sort of tax problem that arises that is not solved by the income tax treaty is self-employment tax income. You do not get a foreign income exclusion or foreign tax credits for self-employment income. This is if you're filing a Schedule C on your 1040, or if you have, you know, active partnership income, these are subject to self-employment tax, sort of the Social Security, Medicare, Medicaid. The United States has what's called a totalization treaty with a variety of countries. So if you have lived and worked abroad in Western Europe or Japan, or like a lot of other developed nations, this is not a problem. But Israel is not one of those countries. It does not have a totalization agreement with the United States. And so there's essentially this this mismatch between with Social Security as it pertains to the US and Israel. So if you are self-employed and have to file a Schedule SE, then you are going to be subject to self-employment tax, even if you already have to pay self-employment tax in Israel. Since you're physically located in Israel, you will be obligated to do that. And in addition to that, you're going to have to pay self-employment tax to the United States. Even though this doesn't include, you know, if you're working as a salaried employee for an S corporation or C corporation, those entities are still going to be doing federal withholdings on your behalf. So it has the same effect, that basically while you're in Israel, both jurisdictions are going to be, you know, demanding you to pay up into the Social Security systems and pay Social Security taxes. It's a 15.3% from the US side. It's a 15.3% flat tax on all self-employment income starting at the first dollar. There's a cap on it, which the Biden administration has considered raising, by the way. So this may actually become an even larger problem in the near future, but at least for now, the cap is at 137,700, increases every year, and there's no cap on Medicare tax. So, and just, I can't sort of stress this enough, this is in addition to Israel's Social Security tax regime. Just to kind of throw out some numbers here, this is basically the amounts that you're going to be paying in self-employment taxes, you know, at various, you know, dollar amounts. So as you can see, this is it's a large problem, and obviously it's sort of the higher up the income bracket you go, the sort of the problem, it sort of caps out, doesn't cap out exactly, but it kind of doesn't get as bad. But these numbers are large enough to, you know, consider other sort of planning techniques. So how do you square the circle? How do you sort of deal with this? How do you sort of, you know, try to harmonize these two competing regimes? And the main way, sort of the easiest way to do it, it's not easy, but sort of the best way to do it anyway, is to convert self-employment income into foreign wage income. Unlike self-employment income, wage income is not subject to self-employment tax. And so it does not create this sort of double taxing problem. So you essentially, what you have to do is form a domestic Israeli corporation, and then essentially kind of use that as like a blocker entity to the US, and then pay into the Israeli system, but not the US system. How is this going to work with folks back home? They're going to be now paying the new Israeli corporation. If you're a US person, you should be able to open a bank account in the United States. There's a lot of ways to, even though you're going to have an Israeli company, to kind of not make it super difficult for the folks back home to pay you. And then, once you have the entity up and running, the Israeli corporation sort of pays out the salary to you, and then this kind of obviates the problem of this double Social Security tax problem. It's not a no-cost proposition. It does require some non-trivial amount of startup costs and maintenance on a year-to-year basis, in the few $1,000s a year. So you have to really ask yourself if it's worth doing. But the consequences of not doing it are very clear. If you don't do it, you're going to end up potentially paying tens of thousands of dollars in extra Social Security tax. Now, it is possible. I mean, there is the consideration that you'll be paying into the Social Security tax of both systems, but it's not so easy to necessarily collect Social Security from both. Not to mention the fact that your return on investment on Social Security is not necessarily the greatest. So, you may be better served investing that money in retirement as opposed to paying into both Social Security systems over the course of your life. It's really sort of fact sensitive, but it is a problem, and there are ways to plan around it. In addition to just the self-employment tax problem, maintaining your business in the United States without sort of doing this and just operating in Israel can create a host of problems for your US company. If you don't really take this into consideration and plan around it, once your US entity has an employee in Israel, it's going to be considered to be doing business in Israel, even if it only has one employee. Once you have an employee, it's doing business in the foreign country, which can sort of create a whole cascade of Israeli compliance issues that Galit's going to get into. But basically, you've now just turned your domestic U.S. company into an international one, and you don't. And if you want to do that, that's great. And it's a fact-sensitive inquiry, and maybe you sort of want to expand and open a branch in Israel, and that's great. But you want to do that on your own pace, in your own way. You don't want to do it accidentally and then sort of be faced with a bunch of compliance requirements that you weren't intending to do. This is just as true for an employee as it is with partners. So if you are, the member of an LLC or a partner of a traditional partnership, as soon as you are touching down and engaging in work on as you were before, but in Israel, you're now creating what's called nexus in Israel. There are also a number of solutions to this this problem as well. I mean, similar to what was previously described, creating its own entity and then kind of paying the previous salary or the previous guaranteed payments or what have you to like an Israeli entity. So there's a lot of sort of planning that can be done, but this is sort of the other reason to do it, is to kind of truly segregate what was going on in the United States to what's happening in Israel, to give yourself more control over the situation. So we talked about income taxes, we talked about self-employment taxes. There's also the issues of retirement. So the U.S. international scheme, and really all the sort of international retirement schemes have this huge problem, which is that retirement is made beneficial by your host country. So there's a whole bunch of IRAs and 401ks and Roths, etc. There's every ABC alphabet soup of plans to help folks save for retirement that aren't respected by any other country. And the inverse is also true. Israel also has a whole host of preferred vehicles to help folks pay for retirement that the US doesn't respect. They don't want to, each country is very protective of its own retirement and doesn't necessarily want to create opportunities for abuse for folks who are international. So the U.S. international taxing scheme largely eliminates the benefits of tax preferred saving vehicles on the on the Israeli side. So I mean, for instance, like if you just had a traditional IRA, yeah, you can deduct those payments into the IRA for your U.S. taxes, but you're still going to be paying income taxes in Israel on it. So it's not really, you get the benefit of deferral, which is certainly not nothing, but it's not sort of tax-free going in and then you pay taxes on coming out. You're really paying taxes both times. So not particularly efficient way to go about it. If you do the opposite and you invest in Israeli tax preferred vehicles, you could potentially get a deduction for Israeli income tax purposes, but then it wouldn't necessarily be respected by the United States. So to the extent that, there are sort of particular dollar thresholds where maybe you could kind of get away with it, but by and large, just because it's tax preferred in Israel doesn't mean that you're going to be able to avoid taxes in the United States. In addition, so I mean, really, the best it can be is sort of an ordinary brokerage account, but of course with the opportunity of deferral. So that really becomes the only kind of remaining benefit to these things is that you kind of get to defer tax along the way, unless of course whatever you're investing in Israel is considered to be a PFIC. PFIC is sort of a relic of not a bygone time, but certainly where there was less sort of international coordination and people moving around and living in various places. And this is a passive foreign investment company. Congress devised this to sort of stop what they considered to be abuse by folks trying to hide money offshore. They were putting, folks in the United States were putting money into literally passive foreign investment companies. And you have the definition here. 75% of the companies, the corporation's gross income was passive, derived from investments that not related to sort of regular, ordinary business, or at least 50% of the assets are investments. So, really foreign investment companies. They were afraid of people in the United States stashing money offshore, putting them in these, investment accounts, and then essentially going unreported and uncaptured by the U.S. tax regime. The problem is that the way things are organized now, a whole host of products that that Congress never intended necessarily to kind of fall within the ambit of this have been sort of scooped up by this PFIC regime. And so, when you're, if you're going to invest in Israel, and you're going to kind of have retirement plans here because you're going to be living here, you're going to be working here, you have to really be on the lookout for these things because they can be kind of draconian in their effect. So, foreign managed retirement accounts, not self-directed ones, but ones that are sort of like a plan that's third-party managed can be an issue. Foreign index funds, certain kind of financial products, certain bank products can all sort of fall accidentally within this definition, which which can have an adverse impact. I mean, the main sort of problems are, is that there's no good solution to it. If something's a PFIC, you fall into one of these three buckets. The first one, the sort of default regime, is on some measure the worst. So I mean, it's deferred, so that's great. You put money in a foreign account, you don't pay tax on it right away. But when you eventually liquidate the account in however many years, they have this this sort of default regime. So let's say that you invested $100, and then 10 years from now, it's liquidated after you retire. What the IRS says is that, okay, we're going to take that $100 of gain, we're going to divide it up amongst the 10 years, and we're going to assume that it accrued in each one of those 10 years. Fine, no big deal. Except that they're going to hit you with interest. You're going to have to pay taxes on at ordinary rates instead of capital gains rates. And they're going to hit you on interest on tax you didn't even have the opportunity to pay. So it's really kind of the worst. It really kind of eviscerates a lot of the benefit. Certainly eviscerates whatever benefit you would have had for deferral, and has a big kind of tax bite. What most people end up doing if they do it intentionally is sort of this mark-to-market regime, and that eliminates the benefit of deferral. So you basically invest in these accounts and you pay tax on it every year. If it goes up, and if it goes down, then you get a loss that you can credit onto future years. It's also taxed at ordinary rates, which is not great, but you sort of don't have this interest problem. So you get to kind of manage it as it goes along. But as you can see, it basically eviscerates the benefit of these retirement accounts. The last thing, which is really the best, is this qualified electing fund regime. The problem is that it's just like very unusual that you can find accounts that provide you with the information you need to actually do it. This one you can actually get kind of capital gains rates, and it's it's really on what's distributed as opposed to how much it's worth on a year-to-year basis. And it's theoretically better. It's just usually impossible to get the information you need to actually fill out the forms, especially if it's like some kind of large index fund. They don't want to give some nobody shareholder who has a very small percentage like all of this information that's sort of very in depth for the company. So you're sort of just left with a lot of bad options when you're investing abroad. So it's just something to consider. I mean, now what I always say is that if you're given, if you're in a situation and someone is giving you stock options or is paying for you to have one of these index funds, I'm not saying that you shouldn't take it, but you just have to be aware that there's all this reporting and potentially extra tax impact. So what are the solutions to this? There really aren't that many great solutions. You can invest in a Roth IRA, which is after tax anyway, and so there you kind of mitigate the impact. The issue is, the only problem with the Roth is that there are phase outs, income thresholds. So depending on how much money you make, it isn't necessarily available to you. But it's certainly the easiest kind of thing to deal with if it works for you. You can invest in foreign equities. It's not that you can't invest in in stocks and things in Israel. You just can't invest in PFICs. But if you want to invest in like an actual operating company and buy stock, you can do that, and then you don't fall into this kind of onerous regime. And then there's like some measure of insurance products that potentially have the benefits for both worlds, but they're again, sort of things that have to be carefully examined and dealt with. But unfortunately, in the retirement space, you're sort of left with not a lot of good options. But nevertheless, you kind of have to continue through. So that is the end of my portion of the presentation. And with that, I'm going to hand it over to Galit, who's going to tell you about the Israeli impact.
So, hello, hi everyone. Thank you again for joining us tonight. Thank you, Jeremy, for this practical presentation, and these are very useful tips. My part of the presentation is intended to supplement Jeremy's in light of the fact that there are Israeli tax aspects that must be considered by US taxpayers who are operating their business from Israel or they're physically present in Israel. Or they became an Israeli resident. So I would like to start with the basic principles of the Israeli tax system. Israeli general tax principles are as follows: that our Israeli residents are subject to tax and reporting on their all income, on their worldwide income, while non-Israeli residents are subject only to Israeli source income. I wrote the different tax regime applied to a new and returning tax residents, and we will discuss this a little bit later. So in the event that the Israeli resident or a certain taxpayer is subject to tax both in the United States and in Israel, we may eliminate such double taxation by application of the Israeli-US tax treaty or by our domestic tax, foreign tax credit regime. In addition, Israel also imposed VAT on goods and services that are provided by a business from Israel, and national insurance payments, Bituach Leumi, for Israeli residents. I'm sorry, I would like to go back to the VAT. The VAT is 17%, and there are exemptions for several transactions, and zero VAT to export of services that may be available to you. Jeremy, please advance the, great. So there are various legal forms for business owners. You can run your business being an independent contractor or atzma'i, an employee. You can be an employee of your own Israeli company, or you are an employee of a foreign company in the United States. You can be a partner in an Israeli general or a limited partnership, and every legal form entails different legal aspects and regulatory compliance and tax rules and costs. Next slide, please. Jeremy. So every business must open an income tax file and a VAT file. And the VAT file is also mandatory for Osek Patur. Osek Patur is someone who doesn't expect to exceed a certain amount of revenue. It is 100,000 Ks per year. You are also subject to monthly and bi-monthly payments and reports to the income tax and the VAT authority, and annual tax returns. Again, national insurance is also something to consider because it is added to your overall tax in Israel. Next slide, please. So if you're an Israeli employee or you have a business in Israel and you're generating an ordinary business income, you will be taxed at a progressive marginal rate that starts from 10% and will go up to 47 or 50% if surtax applies. You will be able to deduct, not as an employee, but as an independent contractor. You will be able to deduct certain expenses that are wholly or exclusively connected to the production of your business income. So the computation is taking all the amount, all the revenue, deducting the expenses, and then you get the applicable tax rate. To this, you can apply tax credit points that are provided to Israeli residents, women, spouses, children, even olim. With the VAT authority, again, there are various options. You may be considered Osek Patur, but you should know that some professions are explicitly excluded from this option. And if you're Osek Patur, you don't have to pay the 17 VAT tax rate, but on the other hand, you can't deduct the VAT expenses. So this is something that is only available to Osek Morshe, an authorized trader. The zero VAT is applicable, as I said earlier, to an Israeli business that provides services to non-Israeli or abroad or from Israel. This is a very complex position. If you have an option to take it, you should consider taking it, because the VAT allows you to deduct expenses, the VAT expenses too. You need to pay advance payments to the income tax authority, which we call mikdamot. These are on account of the income tax that you will be subject to at the end of the year. If you overpay the tax applicable to your income, you will be able to get a refund with the interest and linkage. But if you pay less, you will be subject to additional tax and the interest and linkage I mentioned. And obviously, as I stated too many times, Social Security payments need to be taken into account, especially with US taxpayers that may not be able to recover those taxes. Next slide, please. So being an employee in Israel is the simplest form of generating income. The income is withheld, the tax is withheld from your salary, also the national security payments, the payment to pension and severance funds and contribution to study funds deduct your taxable income. You don't need to submit annual tax returns unless you're considered a high earner or you are a controlling shareholder of a company, meaning you own more than 10% of a company, an Israeli company. An employee is not subject to VAT, as the VAT law excludes services that are rendered by an employee. You should also consider Israeli law, labor law requirements. Next slide, please. So, on the other hand, if you want to run your business through a company, you may establish or form an Israeli company that will be subject to tax on its worldwide income. I should also add that the Israeli income tax ordinance are subjecting non-Israeli companies to tax if the company is managed and controlled from Israel. In some cases, those non-Israeli companies which are operating from Israel will be subject to Israeli source income. As a company, you may deduct expenses. Let's say if you pay yourself a salary, then you will be able to exclude such a salary from the income of the company. The corporate tax rate is 23%, and any dividends that you will distribute will be subject to 25 or 30% in case of substantial shareholder. This is very interesting because Social Security does not apply, and in some cases you would be able to decide what portion of the income you want to retain in the company and what portion of the income you would like to withdraw. So it gives you a kind of a flexibility when you generate income by a company. I just want to make a note. There is the reference here in the slide to the section is a mistake. We will circulate a new presentation, which will include reference to the right section. It's 62A. This section was enacted a few years ago to make service companies, which we call a wallet company, to treat their income as an ordinary income, and it taxed immediately all the income without deferring the tax to the event of dividend distribution. So this is, if you decide to operate as a company, this is something that you need to consider to see that you are not falling within the frame of section 62A. Next slide, please. So the additional cost of an Israeli company, other than the taxes that I already mentioned, are the formation fee. This is a one-time fee that you pay to the company register. There is a reduced fee to the online formation. You would have to pay an annual corporate fee, and associate legal fees vary because you need to submit, in some cases, annual reports to the corporate register. And this is the most important issue because it's the most sensitive one. Bookkeeping and accounting fees are a little bit more expensive when it comes to Israeli companies. So forming an Israeli company is a little bit more expensive than being self-employed, but maybe worthwhile depending on the circumstances, especially with the US person with self-employment tax obligation that Jeremy discussed earlier. Next slide, please. So tax treatment of business of new returning resident, the 168 amendment that was enacted in 2008 with an effective that started 2007 provides extensive tax benefits for new residents and returning residents. And it provides exemption from tax and reporting for a period of 10 years. It's the clock starts ticking from the moment you became an Israeli resident, and this is a separate topic because date on which a person commenced his residency is something that is needs to be determined by a facts and circumstances basis. However, the benefits that are granted to individuals are granted also to non-Israeli companies. The law provides that an Israeli company would not, a foreign company would not be regarded as an Israeli company just merely on the basis that its shareholders, let's say, immigrated to Israel. However, it's not the problem is with ordinary business income and employment income, because the income tax authority is narrowing down the amendment and the benefits that it granted. They introduced the concept of mixed income and permanent establishment in various tax decisions and circulars that they issued since the enactment of this amendment. The concept of mixed income provides that if you're generating income both in Israel and abroad, then the Israeli portion needs to be taxed in Israel, and you're not eligible to any exemption. And the same works with permanent establishment. If you're working or you're a manager of a non-Israeli company and you immigrated to Israel, then you need to take into account that some of the income may be attributed to Israel and then be taxed as such. So initially it was only a concept, and when people wanted to get certain clarity or certainty with respect to their operation, they got decision from the income tax authority or different tax rulings or assessment agreements. And then on December 2020, 1 month ago, the Supreme Court ruling of Talmin for Saba was published. And in this case, the Supreme Court upheld the Israeli Taxing Authority approach to this bifurcation of income. And it actually accepted the method of bifurcating the income according to business days, although taxpayers have the right to substantiate the attribution of a bigger portion to the non-Israeli source. So this became really complex, especially now with the corona, that people are stranded in some countries, including Israel, including from tonight. So this is something that needs to be carefully addressed and considered. It can be, the taxes between the two jurisdictions can be mitigated, and it's important to reconcile between them. And as I told you, there are various ways: bifurcating the income according to a business days formula or some other method. You can utilize the foreign income tax exclusion if it's a good thing to do in a particular case and take a position here in Israel. You may be able to benefit from foreign tax credit in Israel, but then you need to take an opinion or a tax ruling or an advice from both sides of the world, Israel and the United States, to maximize the benefits that are available to the new and returning residents in Israel. That's it on my part.
Thank you, Galit. So guys, I know this can appear to be an overwhelming amount of information, and there's obviously a lot of compliance issues to worry about, but it's not too much to do. And really what we're here to do is to just kind of highlight the kind of the biggest kind of toe traps, kind of the things that you have to be aware of. Because what you don't want to do is you don't want to kind of just go in blind and not necessarily know what's coming at you. We provide this information so you can kind of get ahead of it. And while it seems complicated, at the end of the day, it's not as complicated as you might think. You know, Galit and I work with a number of folks, both in Israel and the United States, who deal with these kinds of things. There's obviously thousands of people who make the jump every year and find ways and manage to do it. There are plenty of folks who operate and deal with these things in English. So even language isn't necessarily a barrier. We have sort of a cohort of colleagues who really help individuals kind of make the transition, make it as smooth as possible, so that you can really just so you can try to make the transition as smooth as it can be. Really, part of what this presentation is trying to convey is that you don't have to shed necessarily the work or the business that you've been building all this time in the U.S. when you make Aliyah, especially now with the advent of remote work and how things are changing literally as we speak in the moment. There's ways to do it. There's ways to kind of get here, hit the ground running, and continue to build your business even when you're abroad. It's easier than ever to continue to cultivate relationships and grow your business even when you're not physically anywhere. So we're really here to just kind of highlight some of the most important things to take into consideration. One thing I do want to make clear, because I guess it wasn't obvious from my part of the presentation, every U.S. person has to file a U.S. tax return, okay? Unless you make a very small amount of income, and that doesn't include self-employment income. If you make self-employment income, you still have to file a U.S. tax return. You should assume that you always have to file a U.S. tax return. Even if you don't have to, I would encourage you to do it anyway, because the IRS, once you file a tax return, the IRS only has 3 years to audit you. So, I mean, I tell people to file tax returns even if they don't have to, because first of all, if you didn't have to, then you probably didn't make much, and it's not going to be very complicated to do. And once you do it, you get the clock running, and then that's always better. So just want to sort of make that clear if it wasn't before. Other than that, there was a host of really excellent questions. I know we didn't really get to answer all of them, but and some of them are sort of very, very specific, but I encourage you to reach out to us individually. I know that Josh is going to distribute our information. In fact, I think it's right here on this last page. To distribute our information, you can reach out to us via email is the best way, so we can consider your question specifically, or set up a time to have a telephone call where we can go over your particular situation. There's not necessarily a one-size-fits-all solution to every problem. And while there are kind of general guidelines for what works, every situation is different, and especially when it comes to business owners, it's even more different. It's even more particular, because not every business is run differently. And while we've been focusing a lot sort of on the service end The calculus is different when it comes to, if you're selling products, that's not, this isn't treated the same way. The services you provide to a company that sells products is going to be sort of falling into this bucket. But, the company itself, if it's selling products, doesn't really kind of, what we discussed here doesn't necessarily capture, how that operates. So, there's obviously too much that we could ever go into in an hour-long presentation. But you guys have been great, asking some great questions. And if we didn't get a chance to answer them, please reach out to us individually, and we'll do our best to answer them.
Thank you, Jeremy. Thank you, Galit. As Jeremy said, this information, we covered a lot of information here. There was a ton of questions. Both Jeremy and Galit did their best to respond to as many as possible on the Q&A. I noticed there were also numerous questions that were really more pure accounting questions and less about some of the more complicated tax applications that require a lawyer, about investments in Roth IRAs, et cetera. Those are really accounting questions. It should be addressed to a Israel-based US CPA and or an Israeli CPA here in Israel. So please do note that some of those questions were beyond the scope of this session. But as Jeremy said, we will be sending out the recording and the PowerPoint presentation here. Both Jeremy and Galit are available for follow-up questions and consultations. Thank you all for joining us, and have a wonderful day.
Thank you.